Apple is a stock market darling. This is a company that 20 years ago, 22 years ago was dead. They had to go beg Steve Jobs to come back. He turned the company around. It is now the stock market darling. So Warren Buffett recently started buying Apple. We're going to go through our entire analysis of Apple. We're going to use our 8-pillar process. We're going to then use our stock analyzer tool, which will tell us what we want to pay for Apple based on revenue and profit, not including balance sheet, okay? My guess is our number is going to be lower than Warren Buffett's. What's the reason? Well, one reason is Warren Buffett has always said as they get bigger and bigger and bigger, it's harder for them to find good investments that they can get above average returns on. So I think Warren Buffett is okay buying a really large company and lots of shares of it that has a great brand, great moat, and can generate a reasonable return on investment. But for you and I, being much smaller investors, we have to be a little bit more picky about our investments, but we'll get into that shortly. Now, one thing I've said before, a good friend of mine named Michael, he owns a private wealth firm. He's a value investor like me. And one thing he said to me recently that was awesome was, because people keep asking me, Paul, when do you think we're going to hit a bottom in the stock market? And I talked to him about this, and he made a great point. He goes, Paul, when people have given up on Apple and Tesla, that's when I feel like we'll hit a stock market bottom. Because this is the way emotions work, guys. The way it works is people have to completely give up for there to be really a bottom. You have to have people just completely capitulate it out saying, I am done, stocks suck, I can't even make money on Apple or Tesla. That's when I'll feel that same way about stocks. If you go look at the dot-com bubble, when people gave up on Intel, Cisco, Microsoft, if you go look at their bottoming out, that was the bottoming out of the market. Okay, that's the thing we have to watch for. When have people given up on Apple? Now, does that mean that you shouldn't buy Apple until then? Not necessarily. We don't know the future. I never thought the last 5 years would have ever happened. I would have never thought that after COVID, that we went from 3,300 in S&P down to 2,190, we would have surged to 4,800. I would have never thought that. Now 2,190 looks like a deal compared to where we are today. So my job, if you're new to this channel, is to be a value investor. My goal is to go out there and find a dollar that I can buy for 70 cents or less. But the bigger the company, the harder the discount because so many people follow it. That is the hard part. And by the way, if you like what I'm doing here and you want to get a little bit more into my personal life, I'm more than just a robot. Go to my Instagram and check out my pictures. I don't do anything having to do with money or investing, but I'd like to do anything about my personal life because personal life shows a lot about what we are as people, right? And I'm not trying to be a robot here. I'm very process oriented, but I'm not somebody who's going to sit there and I still look for value in qualitative ways, right? But my first screener is using my 8-pillar process to screen quantitatively on a company. If I don't like what I see there, I move on. So that's what I'm looking at. So let's go take a look at Apple here and figure out what we're going to do. So if you have our software, please pull it up. So let's look at Apple. All right, first things first, when I look at the company, I look at their dividend and can they afford it? So the dividend's 0.6%. That's like nothing. I think the S&P is at 1.3, 1.4% or something. This is such a small dividend and it costs them $15 billion a year. So don't be like everybody else who assumes a dividend is just safe. Dividend is paid out of free cash flow. A lot of companies will take on debt or use their stockpile of cash to pay a dividend just to attract more investors and get the stock price up. But here, this $15 billion, I compare it to their 5-year average free cash flow of $78 billion and last year's of $108. It is well below the mark where I'm worried about this dividend. So I think this dividend is very safe, okay? Plus, they generate so much cash. What else can they do with it? All right? So let's go look at the 8 pillars tab. We'll show you a little bit about the company. Okay, so we have 6 check marks, 2 red. And this is a very common theme. The 2 red are the 5-year PE and the 5-year price to free cash flow. Okay? Now, these are major valuation metrics. Does this mean you shouldn't buy it? Not necessarily. Remember that a company can justify a higher multiple if they have a great moat and or a great growth potential. So as an example, if I told you Apple is going to grow 100% a year for the next 10 years, hell, I'd pay 100 times free cash for 100 times PE, maybe even more than that, definitely more than that. That is the point here. It's all part of a story you're telling ourselves. Now, one thing I will say is they are buying back a lot of shares, 22.2% in the last 5 years. I don't necessarily like that because of this high multiple and very low dividend. Companies should buy back shares when they're allocating their capital and buying back cheap shares. I don't necessarily believe these shares are cheap right now, But in the last 5 years ago, it could have been cheap, and that was part of it, okay? So some other things to look at: very high return on invested capital. That means they invest the money they get a great return on the money that's invested in the business. That's an incredible number. We want it to be above 9%. It's 35%. Very low debt. They can pay off their debt in under 2 years of free cash flow. And increase in revenue, increase in profit, increase in cash flow. All around great. So what are we doing here with the company? This is a new part of our website. It gives the analyst estimates. Now, the one thing I want to comment on, guys, if you join our software, these analysts, are you telling me there's only 46 analysts that cover Apple? There's thousands, but our data feed gives us 46. So these estimates are going to be a little bit different depending on what website you go to, but they're all around probably going to be relatively similar, okay? But right now, the estimates for Apple, look at the slow growth on earnings per share. It's mid-single digits. Let's go to the bottom for revenue. Low single digits. So this is not a big growing company, but it's got a great moat. So we're going to use the stock analyzer tool and our assumptions about the future, because every investment is the present value of all future cash flow. And so we don't know the future, so we have to make assumptions based on that. I like using analysts as a starting point for my high multiple, because I believe analysts tend to be a little bit more biased on a company, especially a big company like Apple. They don't want to be wrong on that one, so they're going to be a little more aggressive for them, okay? They don't want to tell people don't buy a company and all of a sudden it surges, especially one like Apple, especially with Warren Buffett involved. So I'm going to go high side, 6%, middle, 4%, low side, 2%. Now, profit margin. Now, you see their 10, 5, and 1 year profit margins are increasing. But again, I still want to be conservative. I'm going to go 21, 23, and 25%. For free cash flow margin, I'm going to do 23, I'm going to do 22, 24, and 26. Even though the last year was the only one above 26, I'm still saying, hey, listen, if they get into more software and they're talking about doing subscribers, I think that's okay. That could be the high side. So I'm okay putting that in there. Now, PE and price to free cash flow. So the current PE is 25.6 and the current price to free cash flow is 23.78. What's the right PE? This is the PE you're going to assign to it at the end of 10 years. Remember, at the end of 10 years, their moat's probably bigger, but their potential for growth is is probably a lot lower. So keep that in mind. I'm going to go with 13, 15, and 17. Same with price to free cash flow. And finally, for desired annual return, one thing I'm doing different now is I used to put the same number in here, but now I'm doing it based on low, middle, and high assumptions. Obviously, the higher the assumption, the less likely it's to happen. So I want to put in a higher margin of safety. And the lower the assumption, the more likely it's to happen. I'm going to put a lower margin of safety. So I'm actually going to do 12, 14, and 16. Now, before I hit the analyze button, it's very important that you go back and rewatch this video. Go understand more and more of how I did it. Even the stock analyzer portion, just rewatch the stock analyzer portion several times. I want you to hear the way in which I look at companies. My goal is to be conservative. I'm not trying to be this crazy, great assumptions kind of guy. I'm trying to be there's a pocket of 10,000 companies out there. I'm trying to find 30 or 40 that fit my wheelhouse. That's it. So when I hit the analyze button, 6 numbers are going to pop up. 3 are a price based on earnings, 3 based on free cash flow. If it's all green, it does not mean go buy it. So what does it mean? It means go do your research and verify these numbers are correct. So how do you do that? Well, guys, we specifically created this community just for that. When I started to become a value investor, I felt alone because there was nobody out there I could talk to. Now we have YouTube, and that's why we created this community. This community right here that we created has thousands of people literally talking every single day about investments. You can go in there and specifically search Apple and go right to the conversation and tag the people who are talking about it. A lot of people have done research. Go look at other sites. What are the pros and cons to Apple? Find the bull and bear case. Have this conversation. But this software was specifically created to make that easier for you. Look at all the tools that we have that are here and coming soon. We have a watch list. So you can add these companies to watch lists for you at certain prices that you get notified by email, app, because all of this is available in the app and over the phone. So let me just show you what comes with this site. Mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content every day in the app and in the software. We give you exclusive daily content. Access to Seth, Mo, and I. real estate calculator coming soon, stock screeners, retirement calculator, and this is the community of like-minded investors who speak on the site. All of this is less than a cup of coffee per day, and our competitors are insanely higher and they don't give you as much. Now, this is a no-brainer to me. If you can increase your returns by 1 or 2% a year or decrease your losses by that, it'll lead to hundreds of thousands, if not millions. Do the right thing, sign up. So I hit the analyze button. Are you ready, guys? The stock is currently 159. All right, a low price of 60, a high price of 80, mid price of 70. This is very low compared to what the company is. I get that. And Warren Buffett's buying around the 120, 130 range. So he sees something, he likes the high ROIC, so you can make different assumptions here to change all this. Let me go in here and look at what I would change. The funny thing is, guys, I'm okay with this. I'm okay avoiding the company for a while I wait for the stock price to fall. So I appreciate your time. Please watch the next video on our 3 stocks that were 8 pillars and how we analyze those as well. I appreciate your time. Please don't forget to subscribe to the channel.